Hello, my name is David Lejean. I am the compliance officer with the UL Federal Credit Union as well as a financial counselor. Today I will be teaching you Money Management 101. We will be going over how to create budgets, what your different accounts are used for, what credit is and why it's important, why you keep hearing about your credit score all the time and why people make a big deal about it. And I know you guys are learning a lot with orientation right now, but money is very important. You will always have to deal with it. It's a big stress in a lot of people's lives, so we want to educate you to help set you up for success in the future. So without further ado, let's get started with Money Management 101. So our objectives for today are to learn how to create a personal spending plan, how to use your checking and your savings accounts, how to establish and manage your credit, and what your credit scores are, and your credit reports, and why they're important. So, let's dive in a little deeper. First of all, where do you start? We advise that you shop around. One important way to do this is to determine what's the same between a credit union and a bank. Well, they're both financial institutions. They hold money. They have the same basic savings and checking accounts. They both have debit cards. They both have loans. So they offer a lot of the same services. As far as what's different, credit unions and banks have different eligibility, meaning credit unions are harder to get into than banks because we serve a certain audience. Banks usually have open memberships, and some credit unions do as well. But for the most part, credit unions serve a specific entity. As for us, we're the University of Louisiana Federal Credit Union, so we only serve students, staff, faculty, and alumni for the university. There are other credit unions for places you work, places you live, places you worship, and places you go to school. So there's limited membership for credit unions. They also might offer less products and services than your typical bank might, but they will offer you better rates, better services typically, and they will offer you lower rates on interest on your loans and typically higher earning rates on certain savings accounts. We will delve into this a little bit later. So make sure that you are picking the bank or financial institution, such as a credit union, that best fits your finances. When it comes to choosing accounts, do you actually need a savings and a checking account? Well, at a bank, the answer would be no. You can go in and ask for a checking account and they will not require a savings account for you. As far as credit unions go, the answer to this is actually yes. If you want a checking account with a credit union, we first will need to open a savings account. Your savings account is your membership at credit unions. So, when you come to open an account, you're automatically started with a savings account. As far as what they are used for, the savings account is for putting aside money for emergencies, any kind of short-term goals you have in the next 3 to 6 months, and any long-term goals you have to a year to 5 years, post-college for some of you guys. As far as your checking accounts, that's used for your everyday deposits and spending. Your debit card is attached to your checking account because of how frequently you use it, as well as any checkbooks you might get, because that's all used for spending. Here we have a little pie chart that shows all the different things you'll need to know and have when you go to open an account at a bank or credit union. The one at the top is does it earn interest, or APY, standing for annual percentage yield. If you have money in your account, you can actually earn money back on that account in the form of interest. That's what an APY is. So, part of your process of picking an institution can be asking, what kind of savings account APYs do you have? These are typically found at credit unions, but big banks do them too. What kind of fees are associated with having this account? This will probably be your number one determining factor when choosing a financial institution, so make sure you choose wisely. We will go into further detail in just a moment on this category. ATMs in branches. Where can I actually go in and do business, and where are your ATMs accessible from? With the UL Federal Credit Union, we only have 2 branches here in Lafayette, as well as 3 ATMs. However, we participate in something called the Shared Branching Network, where you can access over 5,400 other credit unions throughout the country and be able to go into there and access your account as though you were at your credit union here. As well as the ATM system, we're part of the MoneyPass network, which gives you access to over 15,000 other ATMs throughout the country without any kind of fees. So these are things that you can know by going to our website or by talking to a credit union representative. This is part of your research for when you're picking your accounts. Does it have any online or mobile banking? Just about every financial institution has some kind of online or mobile banking presence, but some have better features than others. Does it have mobile check deposit? Does it have an app? These are important questions that you need to ask yourself before making your decision. The last 2 categories are in blue because these are what you actually need to bring with you to open your account. The opening documents will be what you need to bring with you to be scanned into the system to get your account started. Typically, this is your driver's license and your social security card at a bank. At a credit union, we're going to need one more document from you. We'll need some kind of proof of eligibility. So, say with the UL Federal Credit Union, being an incoming freshman, you should either have some kind of acceptance letter. If not, your student ID will do just fine. Your opening deposit is the money you actually have to bring to get your account started. Typically, there is a fee and a required deposit to open any kind of account. Knowing the costs. Make sure you're reviewing your fee schedule or account disclosures before you sign for your account. This is where the nitty-gritty is going to be in, and where you'll see all the fees and different kind of disclosures that you need to know before you make that final commitment. Here we have an example of a big bank's monthly service fee, meaning this is how much you're charged every single month just to have a checking account with them. $12 a month adds up to $144 a year. So let's make sure we're picking the best account for us and that we're avoiding these service fees. This bank does offer you ways to avoid the service fee in one of 3 ways. Either you can have a direct deposit totaling $500 or more made to the account. Usually direct deposits you receive that are more than $500 are going to be your income. So this is a smart move by them having you requiring your paycheck going to that account, because then they become your primary financial institution. Another way is to constantly have $1,500 in your account at all times. Meaning if your account at any point throughout the month has $1,499 in it at the end of the day, you're going to be charged the $12 even if you kept it above or at $1,500 the whole rest of the month. The last way is to have $5,000 between all services and accounts you have with that financial institution. That does not include loans. That's any kind of money that you put into that account, whether it be an investment or a checking or savings account. So another way you can incur fees is through saving account withdrawals. We call these excessive withdrawal fees. So this is, say you withdraw more than twice a month, you are charged $5 for every savings account cash withdrawal after that point. So make sure you're reviewing that fee schedule. A foreign or out-of-network ATM is an ATM that's not part of your ATM system. So make sure that when you're going to use an ATM for your credit union, that it's part of the MoneyPass network, say for the UL Federal Credit Union. These ATMs typically give you a warning before you use them, saying it will cost X amount of money, let's say $2, to use that ATM, and you can accept or reject that fee. The thing is, that's not the only fee you'll receive. Your financial institution also charges their own fee. So when you're looking at the fee schedule for a foreign ATM, that's what you get on top of the ATM you're currently using for that transaction. So say you use an out-of-network ATM, the ATM charges you $2. Well, your own bank might charge you an additional $2. So where you think you're only being charged $2 initially, you're actually being charged $4. So make sure you keep that in mind. Next is a stop payment request. If you send out a check or some kind of online payment and you realize maybe it's fraudulent or your check never went to the address that you sent it to, you can put a stop payment request on that particular item. A stop payment request can usually range between $25 to $35. But if you're sending a large payment, say for rent, you might want to incur that fee rather than someone stealing that money. A money order is an item you can purchase from a financial institution. Some gas stations have money orders, and even post offices. These are kind of like checks, except you pay for them ahead of time and you have to fill them out yourself. Some people prefer these because it's guaranteed money, it's already been paid for. But there are fees for money orders. Typically you can't get a money order for more than $1,000, so if you're making a large purchase, you have to get multiple money orders, and they can range anywhere between $1 and $3 per money order. So make sure you know how much you're paying for ahead of time. And the last thing is non-sufficient funds, overdraft, and return item fees. So if you've ever heard of a check bouncing, this is what we're referring to as far as returned items go. Non-sufficient funds are when you try to use your debit card and you don't have enough money in your checking account. Overdraft is a service that financial institutions offer where you willingly go into the negative, the credit union paying for the difference of what you don't have in your account and charging you an overdraft fee, typically between $25 and $40 for that service. So where you might be going to lunch and buying a $5 meal, if you only have $4 in your account and your overdraft covers the $1 you're missing, you will be charged an additional, say, $30. So where you might be getting a burger and fries, you thinking you're only paying $5, you've actually just paid $35 for that burger. Here's some tips for managing your account. For the savings account, make sure you're setting goals ahead of time instead of relying on loans or credit cards. This saves a lot of money in the long run because you don't have to pay interest back on that. We ask that you pay yourself first if you receive any kind of regular income, whether it be per month or per semester. We ask that you put 20% of that income aside. That way you have some for later in case you run into any kind of emergencies. If that is not possible, then just try setting aside a smaller amount, say 5 or 10%. It is important to start at least putting money into a savings account because it builds up a healthy habit of doing it in the future. Having money in your savings account can prevent future issues where you might, say, go to the hospital or your car gets a flat tire. Then you'll have money left over just in case. Make sure you begin now and save regularly. If you do this, it'll create positive habits, which will set you up for a better future. That way you'll have money for vacations or putting a down payment on that first car or home after college. Make it easy. Automate your savings deposits with an automatic transfer or payroll deduction. You can actually set up your account to automatically transfer monies during set days of the month, or just take it directly off your paycheck and put it into your savings. For your checking account, make sure you keep it above a $0 balance, or it'll cost you with the fees that you'll incur. Make sure you're checking your transactions often. It's good to know where you spend your money, especially your expendable income. That way, any kind of income you have left over, you can try to avoid going to that place too often so you can start saving more money. Know what your balance is and deduct any items that may be pending before you spend it. A lot of accounts that use debit cards have an available and a current balance. Available being whatever your current balance is minus the deducted items that are pending. When it comes to checks, though, there's no way for us to electronically keep that in mind. So it's up to you to actually remove what from the check you already spent. So if you send a $500 rent check and you only have $600 in your account, you should keep in mind that you only have $100 to spend. Because if you spend more than $100, your check's going to bounce and you'll get a fee. Create a budget. Tell your money where to go. You can make a list of what you get in income, whether it be per semester or per month, depending on how you get it, versus the expenses you have. If you pay so much on gas every month, so much on a credit card bill every month, so much on a phone bill every month, and you only earn a certain amount, you can write it down and see where your disposable income is. So you would subtract the different bills you might have, how much you spend on food and gas, typically every month, and then you can see where your wiggle room is. This is the best way to see how much you actually spend. Try and start a way for you to cut down on those spending habits that might not be so good. But more importantly, it'll help you to better save your money and see how much you want to start saving and set goals. So here's your little chart that shows how your savings account actually adds up. So let's say you like Raising Cane's a lot. You eat there 3 times a week. A box combo over there is a little over $8. So if you can convince yourself to either buy some bread or some lettuce, some deli meat, maybe eat a sandwich or a salad instead of going to Cane's that 3rd time that week, you can set aside the $8.50 you would have spent there into your savings account. If you can do this at least 3 times a month, then you can save $25 that month. So over the course of a year of saving $25 a month, you've already saved up $300. For some people, this can be your summer vacation. Over the course of 5 years, you'll have saved over $1,500. This is based on a 0.11% APY that you've earned $4 from saving $25 a month. As you can see, if you double it up, $600 from saving $50 a month, which is not hard to do, especially once you have a regular income, you'll save over $3,000 in 5 years. And so on and so forth. So, moving on, we're going to be talking about credit now. Credit can be considered your financial reputation or your financial trustworthiness, meaning credit is how much a financial institution or a lender can trust that you'll pay back the loans you're given based on your history of doing so. Different terms when it comes to credit are your credit bureau. These are 3 different companies that compile data about you that they receive based on your credit history, and then they share that data with others. What they compile that data into is called a credit report. It contains records of your credit accounts and how well you've paid them over time. And based off of this credit history and repayment behavior, something called a credit score is made. So since there's 3 different credit bureaus, you'll have 3 different credit scores. These credit scores are a 3-digit number that represents how likely you are to pay your obligation or loans back. Credit scores are used by a lot of lenders to determine what interest rate they will set or whether or not they will accept your loan, because this is just a quick snapshot of your credit report. So if you want to think of your credit report as your report card at school, containing all your grade data, then your credit score is just your GPA. Interest rate, otherwise known as your APR, rather than the APY that you earned in a savings account. APR, or annual percentage rate, is how much you're charged to borrow money. This is what is determined by your credit score, and it could cost a lot of money if your credit isn't doing so well, and we'll go over exactly how much that can be later. Collateral is any kind of cash or asset that is held by the lender to pay your debt in the event that you can't make a payment. So typically this is cash that they put on hold in your savings account, or it could be a vehicle or home that they can take in the event that you can't afford the loan any longer. This helps reduce the interest rate because it has less of a risk on the financial institution or the lender on doing business with you. Let's go over the 3 different types of credit. The first is revolving credit. These are typically your credit cards. They have different payments each month based on what you had owed over previous time and the interest charges that come with it. So every month you can either pay the minimum or pay all of what you owe on a credit card. The reason it's called revolving is because that changes based on your repayment behavior. So it can be different month to month. Your open credit are things that you sign up for with a contract, such as utilities, cell phone bill, apartment complex, or a gym membership. These are services you pay for in full every single month and aren't typically reported to credit bureaus unless you end up not paying them back. The last is your installment credit. So these are your vehicle loans, your mortgages, home loans, or your student loans. These are your loans that you're given, and you set the terms before you're given the loan of how much you're going to pay back over a set period of time at a certain interest rate. The top 2 things that will impact your credit, whether it be positive or negative, will be revolving and installment. So, 5 different ways you can get your credit established are, first being a credit builder loan, which are typically found at credit unions. It's a loan for a small amount where the money for the loan is placed into an interest-bearing account and released for use after the loan is paid or the funds are used to pay back the loan. So say you want a $300 loan to get your credit started. You can use that money for whatever you want, or you can just keep it in your account. The reason for this loan is to show that you can pay money on that loan over a period of time. And by using a credit builder loan, you typically get a very low interest rate, and you can set it to a 6 to 12 month period to start setting up a credit history, which we will go over why that's important a little later. You can get a secured credit card or loan. It is similar to the credit builder loan in that you have money set aside in your account. For example, if you want a $500 limit on your credit card, then you will leave $500 on hold in your savings account. That way, if you end up not being able to pay that credit card back for any reason, the bank has that money on hold to take and pay it off for you. Once again, this will lower your interest rate because it will be less risky for the financial institution. If you can't put down $500 or any kind of sum like that to have a secure credit card, then what you will be getting is an unsecured credit card. But make sure you're going for a low interest rate credit card. That way you're not spending too much money. This isn't a new purchasing tool as free money, but it's a way to establish credit. So make sure you're going to a financial institution to get one of these. Typically, credit unions have lower rates on theirs. Don't go to places where you shop frequently, because you'll be more incentivized to actually spend money there that you wouldn't normally. If you go to a credit union, you can get a lower rate card with a lower limit That way you're not too tempted to spend more money than you should. Another thing you can do is get a cosigner for your credit card or a loan, because some financial institutions won't give you a credit card or a loan if you don't have any established credit yet. What a cosigner does is it has a second person there to guarantee that you will pay back that card. So basically, you're borrowing their good credit to get a credit card for yourself. But the risk in that for the cosigner is that they're equally responsible for that credit card or loan. So in the event that you can't pay it back, it's on them, and it impacts both of your credits negatively if it is not paid. You can also be an authorized user on an already existing credit card. So say your parent or guardian has a credit card with an $1,000 limit. It can add you as an authorized user where you get your own card with your name on it, but you share that $1,000 limit. Meaning, if they spend $100 and then you spend $50, then that credit card has $150 that needs to be paid back. So next, we're going to be moving over to credit score and credit reports, and to going into deeper detail in those. So your credit score is based on data from your credit reports. That's created what's called a FICO score for each credit bureau. Your credit score will range between 300 and 850, 850 being the highest, and typically over 730, giving you some of the best interest rates for loans and services. These scores will change as frequently as you lend or pay back whatever kind of credit you might have on file. So this graph is a breakdown of our best guess of what your credit score is compiled of, because we don't know exactly what it is, because they haven't given us a formula. The number one thing, more than anything else, that will impact your credit score is your payment history. Do you pay your loans back? Do you pay them on time? Have you ever missed or were late for a payment? This will be the number one determining factor on raising or lowering your credit score. The second one is the amount you actually owe, meaning how much have you borrowed versus how much could you potentially borrow. If I have a $1,000 credit card and I'm constantly keeping the limit at $900 or more, then that means I am using 90% of the overall amount that I could be using, and that creates distrust in financial institutions that I am spending my credit wisely. So that'll actually lower my credit score. But if I'm typically keeping that same credit card at instead at $100 or less rate, then that means I'm using 10% of my overall credit capability. That will actually impact my credit positively. So make sure if you have any kind of credit cards or revolving credit that you're keeping those amounts as low as you can. But you still have to be using the cards and paying them off to build credit history. Just make sure you're not maxing them out or you'll actually be lowering your credit score. The next thing that will most impact your credit is the length of your history. So if you have a credit card that you've only been using for 3 months, that is not going to be as heavily determined in your credit score as a card you might have had for 3 years, because the card with 3 years shows a history of repayment. And if they trusted you enough to let you keep a credit card for 3 years, then that will be more impactful towards your overall credit score and actually boost your credit score far more than even a good repayment behavior on a newer card. We do advise that you keep as few forms of credit as possible, but at least one credit card with a length of history that'll help boost your score. Any new credit that you've obtained, whether it be loans or a credit card, will account for another 10% of your overall score. And the last 10% is a credit mix based on the 3 different forms of credit we went over earlier. Revolving, installment, and open will determine this last 10%. So here we have your 3 different credit bureaus: Equifax, Experian, and TransUnion. And we're going to go over your credit reports and information about them. Companies are not required to report your financial activity to credit bureaus, but a lot of them do, and that's actually to your benefit because that can show your positive spending behavior or your negative. But if they don't report that, then you don't even have credit history established. So it's good that companies report this data. If you ever go to a payday lender or any kind of lending agency like a payday lender, they actually don't report your credit activity. So make sure you avoid those places because they also charge you a very high interest rate, and they're kind of like modern day loan sharks. So I would advise that you avoid those places and go to a trusted credit union or bank before you lend with one of them. Each credit bureau might have different information on file for you, and because of that, they might have a lower or higher credit score. Any information, positive or negative, stays on your credit report for 7 years, and if you ever file for bankruptcy, that will be on there for 10 years. But typically when it comes to your credit report, a majority of your credit report is determined on the last 2 years of credit history. What actually is on your report are any open and closed accounts that you have, whether those be loans, any accounts that you had that were sent to a collection agency, liens, bankruptcy, or judgments. So this will have all your loans and credit cards. It'll have your payment history on those loans and credit cards, whether they're on time, late, or you missed it. As far as people who actually requested to look at your credit history, these can be the lenders who are actually trying to get your loan through, but they can also be anyone that you're applying for a job for. Some jobs will not let you work for them if you have bad credit. Another place that looks at your credit history are any kind of landlords or apartment complexes managers. They will actually deny you a room if you have bad credit at some places. So this is why building good credit is important, because it impacts more than just lending. Make sure you're reviewing each report for accuracy and disputing your errors. Is your account and personal information accurate and up to date? Are the accounts and loans really yours? There can be somebody with the same first name and last name as you, and their information was accidentally reported on your account instead of the other person's. Are there any debts that you owe that you may have forgotten about? If you haven't any established credit, then this probably isn't an issue, but as you get older, this might actually happen. It's also important to review your report because this is a good way to detect any kind of identity theft. If, say, an identity thief managed to get a minor data when they're 10 years old, and you don't check your credit report till you're out of college, then when you're trying to get your first car or home, you might be denied or charged a ridiculously high rate because when you're 10 years old, an identity thief used your information to get a mortgage, to get the money, and then never pay on it. So this is why it's important that you're reviewing your reports, especially if you've never done it before. So here we have items, both negative and positive, showing what your credit reports look like. On the negative item, it starts off with the main collection agency. It'll show your original creditor being the one who gave you the loan and the status of that loan. It'll show if you still have a past due amount or whether or not you paid it with all the information on the loan below. For an account in good standing, it'll show your original creditor. Below that, the information on the creditor and the current status of your loan. And beneath that, it'll give all the terms for your loan, and then it'll show your repayment behavior month by month. So, make sure you request your free credit report. You can request one once every 12 months. So, if you get your first one this month, August of 2020, then the next credit report you can get for free will be in August of 2021. Since there's 3 different credit bureaus, there's 3 different credit reports. If you've never pulled your credit report before, we recommend pulling all 3 to check for accuracy and to check for identity theft. Once you've done so, 12 months later, say August 2021, just pull one of those credit bureau reports. And then every 4 months after that, pull the next one. So starting with Experian, wait 4 months. December, pull TransUnion. Wait 4 months. April, pull Equifax. And then start all over next August with Experian. Your credit score is not included with your credit report, because if you know what's on your report card, then you should have a good guess of what your GPA is. If you really are curious though, we recommend Credit Karma. They do an estimate of what your credit score would be, not what your credit bureaus actually report, and they are usually pretty accurate with that credit score guessing. And it doesn't impact your credit negatively, which checking your credit score with credit bureaus can actually lower your overall credit score. So make sure you're using free credit score checking services like Credit Karma, or certain financial institutions have your credit score included on the app. These work similarly to the way Credit Karma does. If you do want your free credit report now or in the future, here's where you go to get it: www.annualcreditreport.com. This is the only actual site where you can get your credit reports for free. Not freecreditreport.com, but annualcreditreport.com. It's the only government-sanctioned website that offers a free credit report. So next we're going to go over the effects of your credit behavior by looking at a 2019 Toyota Camry. Priced at $23,000 over the term of 60 months or 5 years. Person A has a credit score of 730, while person B has a credit score of 599, and they're getting the same exact vehicle at the same price. Person A, because of their good credit score, is charged an interest rate of 2.95%, while person B is charged 17.95% for the same loan. Person A only has to pay $413 a month, while person B has to pay $584 for the same loan. So over the course of the 5 years or 60 payments, person A only had to pay $1,768 additional dollars because of interest, while person B had to pay over $12,000 in interest. This is a difference of over $10,000 for the same exact loan, all because person A had a better credit score than person B. This is a real-world example of why credit's so important and why we're here teaching you about credit, because we want to make sure that you're establishing good credit behavior. So, tips on managing your credit are: make sure you're paying your bills on time. This is one of the most important ways that you're going to build and maintain good credit. Don't forget to pay your bills. Put it on your fridge, put it on your phone, and definitely utilize autopay. That way, it'll pay your loans for you. You just got to make sure there's money in the account it's drawing off of. Don't avoid your medical bills. Call anyone you might have medical bills with and request payment arrangements to make sure that you're paying your bills in full and they don't take any kind of action against you. That will reduce your credit. Make sure you're reducing your debt by only having one credit card at a time and by paying off any extra loans you might have. Smaller loans first is our recommendation. And if you have a lot of different loans and you want to only be paying one at a time, you can do something called refinancing, where a different financial institution can actually buy those credit cards or loans by paying them off and creating that loan at a lower interest rate, or giving you the same credit card with the same balance at a lower rate with them. This is another good way to save money. When using a credit card, make sure you're only using it for purchases you can afford, such as food or gas that you would normally pay anyways. Don't go crazy, don't get greedy. Pay off that balance monthly. Make sure you're not going over the amount you would normally spend and that you're not maxing your credit card out. You want to keep them low and any other forms of revolving credit low so you can actually build credit versus making your credit score go down. And here's some reminders. Review your savings and checking account requirements and fees before you make a commitment to that financial institution. Set payment reminders for your bills. Request your free credit reports and analyze them for accuracy and make sure there's no kind of fraud going on. And you can visit us at the UL Federal Credit Union to start your savings or checking accounts, to look into loans, and if you need financial counseling. We're located at 619 McKinley Drive, Suite 101, in the parking garage across from the Student Union, at 805 Bertrand Drive, Cata Corner from Cajun Field. You can call us at 337-482-6956, and we can direct you to wherever you need help. Or you can visit us at www.ulfcu.com, and we should have a majority of information you received in this presentation and more so. Alright guys, I want to thank you for listening to my presentation today. We at the UL Federal Credit Union are more than happy to help any students, staff, faculty at the university that need help with their loans, any new accounts they'd like to get, any questions they have at finance in general. So please visit us at either location. Please give us a call or visit our website, ULFCU.com. If you have any further questions, we'd be more than happy to help you. We hope you have a great semester and enjoy your time here at the University of Louisiana at Lafayette. Thank you.